Welcome to The Explainer. I am so glad you're joining us today because, well, we are tackling a seriously critical topic for the financial sector. Today, we're taking the SASB standards on discriminatory lending and translating them into a clear, totally actionable roadmap for your compliance and ESG reporting. Whether you're the one building out the data infrastructure or you're the person reviewing the final disclosures, this explainer is going to give you exactly what you need to know. Here's our game plan for today. We'll quickly run through Section 1, the discriminatory risk. Then, 2, measuring demographics. 3, reporting legal losses. 4, fair origination policies. And finally, 5, the compliance takeaway. Let's jump right into how SASB expects you to navigate all this. Okay, let's anchor ourselves real quick to the official source framework. Just as a reminder, back in August 2022, the International Sustainability Standards Board, the ISSB, took over responsibility for the SASB standards. But the big takeaway for you right now, this specific standard is effective for annual periods beginning on or after January 1, 2025. So the clock is literally ticking to get these reporting mechanisms dialed in.
Section 1, the discriminatory risk. We're going to look at the systemic and financial impacts of lending bias.
We really have to start with the why, the severe business consequences that make this compliance so absolutely crucial. Look, the mortgage finance industry aggregates a massive amount of data to determine loan terms, and we all know that managing these complex pricing models is a huge headache on its own. But as the standards point out, this highly complex process can unfortunately result in intentional or even totally unintentional discriminatory lending practices. And if bias creeps into your origination process, the fallout is severe. We're talking regulatory fines, massive legal settlements, terrible reputational damage, and the very real financial hit of mispriced loans.
So the bottom line is that to mitigate those massive financial impacts, the SASB standards state you've got to actively reduce the risk of discriminatory lending. How? By implementing rock-solid processes, enforcing strict internal controls, and, this is key, proactively monitoring your loan portfolio. This foundational idea directly leads us into our very first specific reporting metric.
Section 2, Measuring Demographics. Let's dive into metric FN-MF27B.1, which demands hard, quantitative borrower data. Under this first metric, you are required to track and report exactly 3 distinct data points regarding the single-family residential mortgages in your portfolio. You need the total number of loans, the total value of those loans, and the weighted average loan-to-value ratio, or LTV. And just so you know, this scope includes first lien and junior lien mortgages, like home equity lines of credit, that you actually hold in your portfolio at the end of the reporting period. Now here's the catch, straight from Table 5 in the standard. You can't just report your grand totals. You have to split those 3 core data points into 2 distinct buckets, minority borrowers and all other borrowers. This is where transparency gets very real, forcing you to show exactly who is getting your capital and under what terms.
Of course, to make sure everyone in the industry is comparing apples to apples, we need a very precise definition. So the standard actually adopts the UN's definition of a minority. It defines it as any group of persons constituting less than half of the population in an entire territory of a state whose members share common characteristics of culture, religion, or language.
So how do you practically categorize an application in your system? Well, the rules are pretty strict. If an applicant is of one or more race or ethnicity, it's a minority mortgage. What if there are multiple borrowers? It goes into the minority bucket as long as the primary or first co-applicant meets the criteria. For those of you operating globally, this is determined based on the jurisdiction where the applicant actually applied for the loan. And finally, for that third data point, the weighted average LTV, you calculate that by weighting each individual LTV ratio by the loan amount and then dividing that sum by your total loan amount.
Section 3, Reporting Legal Losses. This details the financial toll under metric FN-MF270B.2.
This metric shifts our focus from your borrowers to the actual financial penalties you might have incurred. You must disclose the total monetary losses during the reporting period from any legal proceedings associated with actual or, listen to this, even just alleged discriminatory mortgage lending. This means any adjudicative proceeding involving your entity, whether it's sitting before a court, a regulator, or an arbitrator.
Pay super close attention right here, because the accounting has to be exact. You include all liabilities paid out to opposing parties, so civil judgments, out-of-court settlements, regulatory penalties, disgorgement, and criminal restitution. But, and this is a big but, you strictly exclude your own legal fees and defense expenses. You are reporting the actual penalties paid out, not the massive cost of your legal team.
The thing is, SASB doesn't just want a raw dollar amount on a spreadsheet. They want the story. First, you have to describe the nature of the loss, like was it a settlement, a non-prosecution agreement, a judgment. Second, give them the context. Was this a fraud issue, a disclosure failure? And third, this is the most important part, what corrective actions did you take? You have to outline the exact operational, management, or tech upgrades you've implemented to make sure it never happens again.
Section 4. Fair Origination Policies. Metric FN-MF270B3 shifts us away from past penalties and looks at the internal policies ensuring fair lending.
Before you can report on your policies to ensure fair terms, things like comparable loan sizes, interest rates, and discount points, we actually have to clearly define what discriminatory origination looks like. Under the standard, it's defined as discrimination on the basis of race, color, religion, national origin, sex, marital status, age, or because an applicant's income derives from any public assistance program. Your internal policies have to be specifically designed to prevent discrimination across every single one of those categories.
So what exactly do you need to disclose to prove you're on top of this? Your compliance report has to detail your specific internal safeguards. You need to prove you have adequate training for your originators and underwriters. You need to outline your strict record-keeping policies. You have to demonstrate that active demographic monitoring of your portfolio we talked about earlier. And finally, you have to showcase the policies that guarantee clear, fair disclosures directly to your borrowers.
Section 5. The compliance takeaway. Let's see how all these metrics wrap up into your prep for 2025.
Look, ultimately, embracing these SASB standards isn't just about ticking some regulatory boxes so you can avoid a fine. As the standard beautifully puts it, entities that develop transparent information, give fair advice, and clearly disclose their lending practices actually assist shareholders in determining which entities better protect shareholder value over the long haul. It's really a direct measure of your organizational resilience and your operational excellence.
Which brings us to the end of our explainer. I want to leave you with one absolutely crucial question to take back to your operations and compliance teams today. Ask them, is our current portfolio monitoring genuinely robust enough to capture the exact demographic splits, the weighted LTV ratios, and the specific legal loss narratives required by 2025? The framework is super clear, the standards are set, and the time to bulletproof your data infrastructure is right now. Thanks so much for joining me, and keep learning.